have to be right back. Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We got our brand new digital studio here. Start off with a nice little glitch. Hopefully you had a nice fly through at the beginning, got a chance to see what the studio looks like. We're super excited about this. Essentially, what we're trying to do here, since we live in California and we're in Silicon Valley, we're trying to combine, kind of the technique of Hollywood with the digital expertise of Silicon Valley. So I'll give you a little behind the scenes look here. You can see what this really looks like. And so here we are. We're, in this green screen room that we created. We spent the last 9 months building this out. And then we had this digital studio made, and you can see here the skyline of San Jose and all the neat little things that we have here as far as that goes. So very excited about this. The objective's still the same, and that is to essentially just have a better chance for people to have a better retirement. And so we're going to continue to answer your questions. You can send those questions in, obviously, as we go. And the questions are sent to the email address at asktom@talkmoneywithtom.com. You can put them onto the chat. You can do, all of these different things during the week if you want. Today, we're going to cover some, I think, big subjects that I think are very important that come from our client strategy sessions that I think you'll enjoy as far as that goes. Because education is important in your ability to have a good retirement, we have 800 videos now on this channel. If you'd like to subscribe to the channel, you can hit the subscribe button, the little bell right next to it. You'll be able to see, when we post new things as far as that goes. And then lastly, you can book an appointment with us if you'd like, just to be able to sit down with Ethan and I for 30 minutes on the phone or video and just discuss your specific situation and see if there's something we can help you with. So really looking forward to this. I hope you enjoy it also. The studio gives us a lot of flexibility in different ways to present this information. So hopefully that helps you to absorb it a little bit faster as far as that goes. I do like to start off the show every week with a summary of what I saw happen in the market this week. I'm going to do something a little bit different this week, what I call Positive Friday. It's something I do about every 3 months, where I talk about the things that I see that are happening in the stock market and the economy that are positive. And the reason I do this is because the news is mostly negative. It's what sells. It grabs clicks and eyeballs, those types of things. And so if I can, try to present the other side, at least we maybe get a balanced idea of what's going on. I think this is a good time to do it because we just had this big run up. And then we spent the last, about week and a half kind of going sideways and down. Not to be unexpected since we did have a big run up, but good time to reinforce why the market might go up from here. I'm not saying it will, but I am saying it's super important as an investor to have a balanced outlook as far as that goes. So let me share some things with you so I can show you. So first of all, this is a chart of the S&P 500 for the year so far. And so you can see we actually hit our peak right away, first portion of the year, and then we hit the bottom on February 24th when Ukraine was invaded. The differential between that very high point and that very low point was 14.6%. And that's somewhat significant to understand. And if you look at downturns in the stock market and you look at the S&P 500, the average downturn is 15% if there's no recession. The average downturn is 36% if there is a recession. So we just had our 15% basically. And so now it's a matter of seeing, are we having a recession? Are we heading into recession? Is there one imminent? Will the stock market come down further because of that or not, right? So we've had this nice run up that you can see. And does that continue into a further run up and to new all-time highs or not? A lot of that has to do with what's happening with the economy. So let's take a look at some pieces that I look at for the economy, that at least on the positive side as far as that goes. So first of all, this is called the Leading Economic Index, and this is from the Conference Board. I've talked about this in the past before. And what we're doing here is looking at this basket of 10 indexes combined into this one Leading Economic Index. If you look closely here, you can see the index is blue and the recessions are these gray bars across the chart. Every one of those recessions was preceded by the index curling over and starting to come back down. And none of these scenarios are happening right now. If you look very closely, the leading economic index is still going upward. It was up last month. is certainly not curling over and coming back down at this point in time. And so, again, that's one of the key things I look for is basically this concept of having, some idea of a recession coming or not. So leading indicators say not yet, okay? And then we look at, consumer spending makes up 2/3 of the economy. And so you can see this kind of crazy chart here. The consumer spending is going up very nicely. And then, of course, the pandemic hit, dropped, dramatically during the pandemic, has come back up and is now continuing forward and continuing to go. So, again, something to watch for. That can change. But at the moment, consumer spending is on a pretty good tear, actually. And then the next chart really just shows maybe part of the reason why is there's a lot of jobs open. Over 11 million jobs. It's a all-time high for job openings. And really what that means is that obviously businesses start to get desperate to hire people. They're going to pay more and more for those jobs. That can create some inflationary problems, but in terms of consumer spending, that gives more and more income to people to be able to keep up with some of those inflationary things and to spend more on other things. So that's another good thing, in my opinion, in terms of recessionary issues. Core CapEx orders. Essentially, this is business spending. And business spending, not including defense spending and not including airline spending. But this shows a really nice pattern also. So core CapEx orders are up. That's another great sign for the economy. Again, can change, but looking very good at the moment. All right. And then earnings are up. And so this particular chart here, the blue line is the S&P 500. And the black line that's right on top of it is the earnings. And if you look at the earnings from the bottom of the pandemic to now, they're going up very strongly and very, very quickly, actually. And we're quite a bit higher on earnings per share on the S&P 500 than we were prior to the pandemic. That trend still looks to be intact to me, still looks to be continuing to go forward. So that's important. And then we look at the estimates for earnings. So this bottom line on this chart are the analyst estimates for earnings per share for the S&P 500 for 2022. That's a very nice upward motion. Estimates for 2023, also even higher, right? Nice upward motion there also throughout the year. And basically, one of the things to keep in mind is the last 7 quarters in a row, the actual earnings have exceeded expectations, the estimated earnings, by a significant amount, 7 quarters in a row. So these are the estimates. And if we keep beating these, it's going to continue to pull that stock market forward, right? So earnings are incredibly important component of this motion. The federal funds rate is what they're always talking about when they talk about the Fed raising rates. They're raising the federal funds rates. And this is a chart going back to 1955. You can see how high rates were back in the 70s and 80s and different things that we are all familiar with. But one of the things to note is, again, you have these gray bars that show the recessions that are happening at any point in time. If you look prior to those recessionary time periods, almost every single one of them had an increasing interest rate first before you had that recession. If you look all the way at the very end of the chart, you'll notice that the line is flat. That's because the current interest rate is only 0.25%, and so really it doesn't even show up. And so without significant increases in interest rates, we haven't had that happen where there's quarter point situation where a recession starts tomorrow type of thing. And there's a lot of talk about recession right now, so that's what I'm responding to. But again, very important to understand, it usually takes quite a few rate increases, and we've only had one so far, right? The average recession starts 3 years after the first rate increase. So first rate increase was last month. So if we take 3 years from that, it'll be March of 2025. That seems much more reasonable for me for a recession. Anything's possible. This is kind of an unusual environment, certainly with the pandemic, the reopening, inflation, and all these things. But historically, it doesn't come that quickly, right? It takes several rate increases. And then here's another interesting piece. Stocks have still done well even during rate increase cycles. So the cycle is considered the first rate increase, which was last month, till the last rate increase when they start to come back down again. And there's 12 of them here starting in 1954. You'll notice that the rate of return is positive on 11 of those 12. So even though interest rates are going up, most of the times the market also goes up, and the average rate of return per year on this particular chart is 9.4%. So a pretty healthy rate of return for the S&P 500, even when rates are going up. So again, important time frame to take a look at. And back to the technical part. Most of what we talked about right now is what we call fundamental, where you're looking at earnings, you're looking at interest rates, what's happening in the economy. Technical analysis is really looking at the charts. And there are an awful lot of people and organizations that use the charts as one of their key metrics for deciding on what to do. And so if you look at this chart again of the S&P 500 so far this year, you'll see this blue line that goes through there. That's the 200-day moving average. Every point on that line is an average for the 200 days prior. And so what they've done here is done some studies on what happens when it falls below the 200-day moving average and then comes back. Okay, so I'll show you one of the studies that was done. Since World War II, there's been 31 times that the S&P 500 has fallen below the 200-day moving average by 6% or more. In those 31 times, 15 times that happened, that it recovered back through the upward, back through the 200-day moving average, just like we did in March, without a recession. So that's what's happening right now. We're not in a recession right now, obviously. And so in those 15 times, there was a positive rate of return on the S&P 500. 12 months later, 15 times, 15 out of 15. 100% of the time when that pattern has happened with no recession, there's been a positive rate of return 12 months later, an average rate of return of 17%, according to this study. So that's really, really good. And what's really interesting, too, is even if there was a recession happening right now, there's 16 times this has happened, since World War II. Still, 11 of them ended up being positive for the S&P 500, at a year later with an 18% rate of return. So very powerful motion. Fall below the 200-day moving average by more than 6%, recover back above that, and you have a fairly good chance of having a positive rate of return, especially historically. And it's, again, one of those things that people look at that might have some impact on what happens here with the markets also. Okay, buy American. I've been saying this for a long time. Certainly, I've always felt very strongly that you should have a globally diversified portfolio until the pandemic. And the pandemic happened, and it really hit the international investing a lot harder. And we stuck with American investing throughout the pandemic recovery here. And that worked out really well. For example, the Vanguard Total Stock Market Index, VTI, is the symbol for the ETF. Since the beginning of 2020, basically has a 15% per year average rate of return. If you look at the Vanguard Total International Stock Market Index, which is basically all the international stocks versus the other one, which was all U.S. stocks, that's only up 2.9% a year on average. So huge difference just because of what's been going on in the pandemic. Here's my point. I think this is going to become even more powerful. Because of the situation in Ukraine, Europe is having more trouble. They have more exposure. They have more exposure to the oil, the gas, and the coal. They're going to try to wean themselves off. That's going to be expensive. It's going to affect earnings. Their growth rates are going to fall. And we're starting to see those markets do a lot worse than we are doing now. China was already having trouble prior to this because of their regulatory situation that they're dealing with, and they had some softness in the market due to that. And now I think they're going to face even more because of the quasi-alignment that they have really with Russia in this conflict, and the Western democracies might start to look at that and create some more problems for their market. That leaves America. We've been the best place to invest anyway. I think we'll see even more global allocation towards American stocks. And I wouldn't be surprised to find out when we get to see the data here if this big run-up that we had in March wasn't really precipitated by international money coming into the U.S. market. I think that continues. We are the place to go right now. And I don't see that changing for a while, because of the situations that in Europe and China are going to take quite a bit of time to work their way out. In the interim, we have a lot less exposure to those situations, and I think our market will benefit from that dramatically, in my opinion. Okay. Then we have a seasonal aspect of April is a good month. Matter of fact, if you look at the last 16 Aprils, 15 of them has been positive. It's a really good ratio. The average rate of return was 3.1%. That's the highest average rate of return of any month in the last 16 years. So April is a really good month on average. So we'll see what happens this time. I do think this particular April, we're going to scuffle around for the first half of it, really, because we had such a huge run up, especially through the end of March, that it's going to take a little while to absorb that. If we are going to get a good April, it's going to probably happen in the second half, but we'll see what happens there. And then last but not least, Warren Buffett's buying. I consider this the greatest investor, on earth, and really has been talking about not being able to find things to buy for a long time, sitting on a lot of cash, and has now, over the last 3 weeks, started to come in and buy. The best investors in the world walk in when everybody else is walking out. And Warren Buffett is finding things to buy in this market. So I think that's something to consider also. So lots of negative things, and I'm not saying that a positive outweighs the negative, but if you don't get some kind of a balance of the information between those two categories, you will end up being more nervous than you need to be, because the news is going to continue to push out that negative piece. And so that's what I'm trying to do. This show started on the 22nd of March, 2020, and I started talking about positive things just to keep my clients from really being nervous about what's happening with the market at that time. We were in a full shutdown, a pandemic, and I'll tell you what, the positive thinkers won. The S&P 500, if you look at the Vanguard VOO, for example, if you bought that on the 22nd of March, you've more than doubled your money. And so all that negative information that's been coming out all the way through all of this was really the wrong side to focus on. So I'm not saying we're going to continue to double every couple of years or what have you, but I am saying that it's super important to understand the positive side of the equation to be a better investor. And that's something I think about all the time. So thank you. I really appreciate this week and look forward to talking to you again next week. All right, Eason, let's get into some of the questions and see what we can cover here today.
Yeah, so our first question today is, how do I manage a 401k?
Yeah, this is a big area now. So lots of money in 401ks here in Silicon Valley, right? I mean, there's just no doubt about it. We've got these big amounts of income that people make here. Companies match. Some of them even match up to 100% of the contribution. I mean, it's incredible what's happening. And we're seeing $1 million and $5 million 401ks all over the place. They have one huge disadvantage, maybe two. One is that really they are managed by the individual. And in my opinion, a lot of times it just gets kind of put aside, and you've got this scenario where it's ignored, or people get nervous too easily because of all the bad news and not enough identification of the good news, and they end up getting out and back and forth. And so here's the new thing now. There's a new platform called Pontera that allows people like us to actually manage a 401k for a client while they're still working. This was not available before. And it's a really amazing thing as far as that goes. So this is one of the things that we can take a look at. And there's a study that was done here. That I'll show you. So this is a study that shows the difference in rate of return between a managed account by somebody, a professional, versus an individual managing their own 401k on average. The differential is 3.32%, right? Which is a lot. In this particular example, it shows a 45-year-old would have 79% more in their 401k by the age of 65 if they average 3.32% higher after fees. So it's a huge difference. And go ahead.
Yeah, so a lot of that is, so with a 401k, we kind of get into this status quo. We have this kind of inertia. We set our allocation and we kind of forget about it. Maybe we just set a target date that kind of represents when we're going to retire. And then over time, we just keep adding money to it every pay period. But we really don't change anything to fit our needs, our risk tolerance. And then we just let go. We just have it sit in the background. And so that's where it kind of like someone managing it or someone taking an active watch of it really helps, because maybe your target date is in international stocks, and we talked about how international stocks have been underperforming US stocks, and so you're losing out on that return by having just a target date that's kind of just broadly invested.
Yeah, and that's one of the key things, is to kind of understand what's in all of those. That's not that easy. You got to have the tools to be able to dig in and figure out what's there and such too. So very fascinating. So we can go in and take over somebody's 401k, do the trades, work with them on their risk tolerance, and help them manage that asset, and work within the list of options that are available inside that 401k. But there's an even more exciting aspect of this, is what's called the self-directed brokerage portion of a 401k. Not every 401k offers this, but we've run across most of them here that we've seen here in Silicon Valley seem to have this option, so that's really nice. And what that does is it allows you to go out and to basically create any portfolio. So you don't have to just buy things off of their list. You can use the self-directed and buy any stock, any bond, any exchange-traded fund, etc. So what I just put up here on the screen is our current 60/40 model, for example. So we have a big chunk of Vanguard Total Stock Market Index and Vanguard S&P 500. We've got a little real estate, Apple, Microsoft, semiconductors, and then we've got multiple different types of bond pieces in there. And that's one of the biggest weaknesses I've seen inside of 401ks as far as the options to choose from, is just right now bonds aren't doing that well. And so, being able to use a Treasury inflation protection security that's doing better right now, or maybe some inflation protected high yield bonds or some standard high yield bonds, those types of things in this environment are doing better so far. And so this is super exciting. We can go in, take over the 401k, help the client get set up with the self-directed brokerage, and then apply our current model, that keep it up, make the changes, and be able to kind of manage that aspect of it. That could be phenomenal.
Yeah, and like the one big issue with 401ks is you only have a limited list of what you can invest in. So I as a person, maybe I like Apple, but I can't ever get to the Apple in my 401k unless I think about doing a self-directed. So it opens up the window of what investments you can do.
Yeah.
And so we talked a lot of funds or 401ks only have one bond fund, or they have one US stock fund. And maybe you don't like that fund because maybe it has exposure to something you don't want to be exposed to, but you don't have the options. So you kind of just have to pick it. And so that's where self-directed becomes really advantageous.
Yeah, I'll tell you another thing that jumps to my mind is that we have a lot of clients that really like the ESG portfolios, and we have a whole set of them. And so that's environmental, social, and governance. These are socially responsible investments. I have yet to see any of those available inside of the limited selection of a 401k. If we go out to the self-directed brokerage, I can take that entire 401k, buy all ESG pieces in that portfolio. I have custom designed portfolios that we can apply to that 401k. And so if that's something that interests you, really the only way to do that is through self-directed brokerage. And so obviously what we're doing is bringing in our expertise to help create that model. We look at all of the risk tolerances and the cash flows and how those things work and the spreads on those ETFs and everything. And then we help that client kind of identify which one works best for them on a risk basis. And then we stand between them and the fear sometimes that comes up in the marketplace, right? So anyway, that's what's happening with 401k. Really fascinating area, very exciting for us. So anyway, that's something new that you can take a look at. All right, so what's another question that we have?
So our next question is kind of like a hot topic. Everyone's feeling it. Whenever we go to the gas pump, we are feeling it now. But what is inflation doing to my retirement, and how does it affect my chances?
Yeah, surviving inflation, just like it says. That's what's been a hot subject. Again, we bring this up from the client, strategy sessions that we have. It's coming up a lot. for obvious reasons. People are seeing, the gas and the food and, just about everything costing more than it used to. And there's a lot of different ways of surviving inflation and fighting inflation and dealing with inflation. We could do a 5-hour show just on this part. I'm going to focus on one piece that I think is really interesting, and that is somebody who is quite conservative with their investing because they're afraid of the stock market dropping, right? And how they're now being infected by inflation and then what they might need to do, in that regard. So, I'll give you an example here. We'll give a view here. So here's a current allocation for a hypothetical client, 30% stock, right? So my conservative clients are 30, 20, 10% stock, right? That they're kind of in that category. And their biggest concern is just losing to a big stock market crash, right? The problem is there is another risk, and that is losing to inflation. They haven't had to face that risk forever. It's been a really long time. We've had very, very low inflation, and now all of a sudden we have very high inflation, and they're having to face that risk. And so, yes, you might be avoiding the stock market downturn, but then losing out basically day after day to inflation. So, and I'll show you how this works and give you an idea. We'll go through a financial plan with this person. So first of all, we would take a look at this particular person with this portfolio, and we look at their basic Monte Carlo simulation. And so this is a huge part of our retirement planning toolkit, so to speak. And what we're going to do here is I'm going to push this button, and it's going to allow the computer to randomly select amongst all the variables. And what's the inflation rate, what's the stock market doing, the bond market doing, all the different variables that fit into this. Inside the plan, we already have this person's assets, how much they're spending, how much they have coming in from outside assets like Social Security and pensions and such. And we want to see, does it work? We're going to run it 1,000 times and see if it works. So I'm going to push the button here, and we're going to see, this Monte Carlo simulation come up. There it goes. And so we get this green spaghetti. And this is a good one. Yeah, 99% probability of success. That's as good as you can get using Monte Carlo simulation. And it basically says that, under this base case scenario, really good chance of making things work as far as that goes. But we can stress test this. And so one of the stress tests is a higher inflationary environment, a persistently higher inflationary environment. So let's just go here. So here we have higher inflation with that current 30% portfolio. We are already at 99%, but what happens if we increase the base inflation rate here from 3.25 to 5? So it's going to do that. And we're going to see what happens with the Monte Carlo simulation. So right now you can see it's calculating, it's running through 1,000 times.
Yeah, I wouldn't want to be retiring on 66%. That'd be really rough.
Yeah, that would scare me, honestly. And so here's the irony. This is a client who's scared of losing money in the market, who in a higher inflationary environment would actually have a pretty good decrease in standard of living in order to make it through. So one of the options, and there's lots of options, right, on how to fight this, and I'm just presenting one simple piece here, is the possibility of increasing the stock component. I was just meeting with a client the other day, and we kind of broke down, the returns for the last 3 years from the stock market, returns from the last 3 years of the bond market, and the stock market was significantly higher on average rate of return. And, maybe that doesn't happen in the next 3 years. It's hard to say. But long-term, stocks have done a really good job of keeping up with inflation. And so that's why we have them. And so if we go now to another scenario here where we just increase their allocation to 60%. Now, that's hard to do. When somebody's at 30, go to 60. And so maybe you work up to it slowly but surely. And this is one part of the plan on trying to fight inflation. So let's see what happens now when we go to 5% inflation. We're going to slide this over. And there we go. And it's going to calculate another 1,000 times and see what happens. Okay, we just moved up to 81%, right? So we're in the green zone. Not perfect, not at 99, but not bad. I'd feel much more comfortable there as far as that goes. And so anyway, that's one of the strategies for dealing with inflation, especially if you have a low exposure to the stock market, is to consider some increase in that exposure just in case we do continue to have these things happening.
Yeah, the one thing is, we want you to be able to sleep at night. A good advisor gets you into a spot where I'm not worried about my finances. I have a good plan in action. I know where I'm going to be. And so we don't want to bump your stock allocation up too much that it's too volatile and it's keeping you up at night. But we also don't want you to have inflation eating away at your plan, so you're also not sleeping at night. So there has to be a healthy middle ground there.
Yeah, exactly. That's exactly it. It's a matter of balancing risks. It always is, right? And understanding, right? The more you understand, the more you have a. I mean, I just gave Positive Friday, for my summary this week, and so the more you understand the positives and the negatives of the market, because I think a lot of times when I'm talking to somebody who's very nervous about the market, they just have too many of the negative pieces in their mind and not enough of the positive pieces in their mind. And so, it drives them down and down and down in terms of their stock market exposure. And again, it's higher exposure isn't for everybody, but it's a challenging situation with inflation for people that have low exposure. So anyway, that's what's going on there. Let's see what else we got going on.
So I'm getting close to retirement. I'm interested in thinking about Roth conversion for my 401k. How does it work?
Okay, so Roth IRA conversions, one of my favorite subjects. One of the subjects that does come up again a lot in our strategy sessions with clients, I guess mainly because we've probably been talking about it a lot, and we really try to help people understand the ramifications of what's going on with their retirement plan. So 401ks and IRAs, 403bs, 457 plans, all of these things that are out there that are set up to be these retirement plans are getting bigger and bigger. People are investing in the stock market. Stock market's done well. Used to be pensions. Now pensions have disappeared, and we end up with this money that you put in, and then the company matches. And so we're seeing these really large amounts of money in those, they're called tax deferred, into those tax deferred accounts. And it's great, right? It's better than not having it. But you do have some significant problems coming your way if you have a lot of money in tax deferred accounts. And so let me show an example here of kind of how this works. All right, so this is a projected taxable income for a hypothetical client who, as you can see here, is about 66 years old right now, and we're looking out until age 95. So you got to pick some age to plan to. We usually pick an older age just because that is the most difficult thing to do in financial planning. If you don't live that long in retirement, then the money isn't stretched and stressed as much as it is if you live longer. So we usually do that. And what you're seeing here in this kind of big purple blob is the projected income for that client. And those little lines that you see, the blue, the green, the orange lines going across there, those are the tax brackets. And so there's some interesting things when you look at this. Number one is you can see that the taxable income is kind of lower at the beginning, and all of a sudden it jumps up at 72.
Yeah.
That's because this person has a lot of money in retirement plans and tax deferred plans, and at 72, the government makes you start taking money out. And that gets higher and higher every year as a percentage. And if your accounts are growing, like they hopefully are, that just means you have to take out more and more and more taxable income. And you can see what's happening there. It's just growing and growing. It's going up into higher tax brackets and what have you too. So really, really important to understand your long-term taxable income projection. This is called tax planning. So you're mostly familiar probably with tax preparation. You fill out the forms like we're doing right now, right? You take it in or you do it yourself. And that's tax preparation. Tax planning is totally different. This is not something that often is done by a lot of people. We do it a lot, where we try to project your taxes all the way out for the rest of your life. And then we can make some adjustments to that and see, okay, how much tax did we save for the whole lifetime? And it's amazing how much money can be saved, I think, on a regular basis. So that's happening as far as that goes. And really, the big thing here is what we call the tax time bomb, right? So this is a situation where, that income is growing and growing and growing. And if you take a look, what happens is at some point down the road, 80, 82, 85, 86, you're pulling out so much money that you're actually having to pay more on Medicare. right? Yeah, you're not paying base Medicare because you're being forced into this higher, bracket because of the income from the minimum distributions. You've got a scenario where maybe there was two of you and you both built up your retirement plans and one of you passes away and now all of the retirement plans are under one name, and that's a really hard situation because now you're a single filer, and that means that you're going to pay more tax on that same withdrawal because the withdrawal is the same whether it's two people or one. It's the total value. And so if you combine them into one person, taxes go way up on that.
Yeah, and you can see at like 66 to 71, that's kind of their base level expenses.
Right.
And so when it jumps to 72, you're essentially doubling that income. And really, you don't want to be taking income from that you don't need.
Right.
You just want to be taking enough income that you can live your standard of living, because you want to pay extra taxes that you don't need to pay taxes on.
Yeah, so one of the solutions, and there's many, and little pieces that can be done here to try to whittle away at reducing taxable income in the future, but one of them is to convert some or all of these retirement plans into a Roth IRA. So just so you know, anybody can do a conversion. No matter how much money you make, anybody can convert any amount from a 401k, or IRA, all of those to a Roth IRA, right? There's no limits. And so the first question is, should I do it, right? Does it work? Is it better or worse? And the second question is, okay, then how much do I do each year? And so that's what we do with this program, is we solve for that. And so here's a scenario where we are converting assets and fitting it. See that yellow line there is the 22% bracket, right? So we've determined that's the optimal bracket for this particular hypothetical client, is the 22% bracket. Doing 24, it actually, your net worth went backwards. Doing 22 worked great, right? And so you can see now this green, blob is the projected income, and you can see it goes right up to the 22% bracket. And the way that works is, let's just say the 22% bracket, make up a number, is 200,000. You have 100,000 of income. You can convert another 100,000 a year and come right up to the top of that bracket. And you do that every year. We do this at the end of the year most of the time so we can see what incomes came in. We're very active with this in this conversion concept. Lots of details here that we won't get into because it just takes too long, about paying the taxes and how you do that. And that can be kind of painful here too, is because we do these projections and it looks good, and we'll finish up and show you how good it looks in just a minute. But it's very hard to pay the taxes. Right?
Yeah, it's so bad. When you convert $100,000 and you have to pay an additional $30,000 of taxes at the end of the year that you weren't expecting.
Yeah.
It's just not a fun experience. And sometimes, people don't convert, all the way to the bracket, but you can still convert some.
Yeah.
You can convert what's in your comfortable level, and that helps you in the long run.
Yeah.
So you don't always have to be optimal.
Yeah.
You just want to be, in a good place that you're comfortable, and you're taking some steps to make yourself a little bit better.
Yeah, move in the right direction. Yeah, I agree with that. And we can kind of compare the two incomes here on this slide. So you can see the green and see how that goes up. But look at what happens to the green behind there. The taxable income goes to zero at about age 83. Got zero taxable income. That's phenomenal, right? What a great solution versus this ongoing, increasing purple blob that's creating a higher and higher potential Medicare costs and those types of things too. That person that has that green one has lowest Medicare cost, for example, because they have zero taxable income. This doesn't happen for everybody. It's a hypothetical situation, but this is really critical stuff to understand to have a really, I think, powerful retirement. And then it goes beyond that too. You can kind of see, just to show you kind of the purple blob at age 85, taxable income with no conversion, $248,420. So that's what's ending up on their tax return that year. If they converted everything at 22% bracket, the green blob, just like we showed, at age 85, they got zero taxable income. That looks good, right?
Yeah, and the idea is you're still having that same standard of living, but now you're not paying taxes on that standard of living.
Right.
That's really important. Now you have so much more flexibility. Say 1 year, I decided I really want this car, but I need an extra $100,000 of money. And if I only have an IRA to take it out from, I have to pay taxes on that. So I have to take a little bit more money to cover those taxes.
Yeah.
But if I have only a Roth IRA, I can take that money out tax free, and I don't have to worry about it going on my income. Same.
Yeah, that's a nice car though. That would be. I could do that. So yeah, exactly right. I mean, you take that out of your IRA, you're gonna have to take $130,000 out to buy a $100,000 car. And so that's a hard thing to do. Take it out of your Roth IRA, you take out $100,000, and you can go buy your car. Yeah. So here's the total for taxes, right? And so this is what we're trying to do. Long-term tax planning. You're trying to make that second bar there as small as possible. So with no conversion, that person lives to 95 is going to pay $1.5 million in tax, in total federal taxes paid. With a conversion, a 22% bracket all the way through, taxes would drop to $826,000 and change. So that's significantly better, right? And that adds up to a higher net worth and a better standard of living. All of these things happen. So this is a big, big area. All right. And then the last is just kind of comparing the estates. So the first one that's just above our heads here is the one with no conversions. So there's no tax-free assets in that, 0%, right? It's all taxable assets and these tax-deferred assets. In the other estate here, now that everything's been converted, the green circle over there, it's 100% tax-free. Now this is not estate taxes, this is income tax. And so what this means to your beneficiaries is that if they inherit the circle above us here, they're going to have to take those tax-deferred assets and cash them out over a 10-year period and pay the taxes on them. And, so for example, if I look at my kids, when I pass away, they could be in their peak earning years. And they could have a lot of extra income just being shoved on top of their income from this IRAs that they inherited from me. If they inherit, say, a Roth IRA instead, same dollar amount, they can let it grow for 10 years. This is why I converted all of my accounts to Roth IRAs already. And I had a conversation with my kids about making sure you keep those for that 10-year period because it grows tax-free for 10 years, and then they can cash it out at the end. It's so much more powerful.
Yeah, and so when someone passes away, taxable and their tax-free accounts at that day of death are pretty much the same because taxable is stepped up to fair market value.
Yeah.
And so the real potential for a Roth account is that you have the extra 10 years. You're forced to take the distribution out at 10 years, but you can grow it for another 10 years. And say maybe you get 7% return. Your account doubles in that 10 years, essentially. So, but if you had that in taxable money, you would have to pay gains on that, whatever doubling is. But you wouldn't have to do that for tax-free, and that's where the power comes in, is that it really helps your beneficiaries have this tax-free asset that's growing for them.
Yeah, it's definitely worth looking at. We talk about it all the time. You can't learn enough about it. There are a lot of details. It's certainly something we'll talk to all of our clients about, as far as that goes. That where it applies, and sometimes it doesn't work as well as we think or what have you, but it really is an amazing thing as far as that goes. So great show today. This is truly a live show, as you can tell by the beginning when all we had was chairs. And so we've practiced this a million times. That's never happened.
No, it hasn't.
Yeah, so, we'll get better at it, but it's really fun. Hopefully you can see the power of the way we can share the information and show the different views. And I just think, honestly, this is a really, really powerful, screen shots and the views and everything are really fun. So I want to thank everybody so much for coming, and I really look forward to you joining us next week. Thank you very much.